Warning. This podcast features the truth about owning and operating mobile home parks. The following program is not designed to be sexy. It will not hype you up on MHPs. Rather, this is a raw take on this industry and how you find your own path to success. Welcome to MHP IRL, Mobile Home Parks in Real Life, with your host, Ryan Norris.
Welcome, everyone. Today, I am so excited to have the Ryan Smith with us. Ryan has, across mobile home parks and self-storage, had over 16,000 units across the two asset classes and has positively rented over 500,000 units across 30 states. His team has a collective over 200 years of experience, and they got started a long time ago, back in 2003. Ryan, I am so excited and honored to have you here, and I'm going to jump right into it and ask you probably the most pertinent question here.
Sure.
You got started in the golden age of 10 caps. Tell us about why that's totally wrong.
I think the first property we bought was even closer to 20, if you can even, it sounds outlandish to even say that those existed. But when we first got started, it was just wild west. Nobody was in the space. No capital was flowing. And so our original model was, I think, as many people get into the space, you're coming from cash flow. So you jump from lily pad to lily pad. You're saying, I'm in a job, I've got X income. I want to replace X income. So when you're looking at mobile home parks or whatever you're looking at it from a how can I generate the most income perspective. And so our original goal, my wife and I, when we started the company, our original goal was to generate $10,000 a month of net cash. And that was what we were going for. And that was a fine goal until we met a gentleman who basically hit us upside the head with a 2x4 in a very tactful, delicate way. And he was a very interesting guy. He's a partner of ours to this day. I think highly of him. I probably learned more from him than anybody. I think at the time I met him, he had 55,000 units under management. We had about 1,000. And so I was listening. And so his comment to us was, that's a mighty fine goal if that's what you want. and I took the bait. So, what should I want? And so he basically, in succinct terms, which is typical of him, he just basically said, you can't earn yourself wealthy through cash flow. You can't grow wealth through cash flow. The tax regime is set up so that is nearly impossible. Focus on wealth and wealth creation, and from that you can generate the cash you want and need, but you will not grow wealth from cash. And so that kind of started and triggered kind of in me the pursuit of understanding a little bit more than just high cap rates, rural markets, huge cash on cash returns, and really not just the dollar as value, but the value of the dollar.
So that's interesting to me, because one of the biggest excuses I hear from people getting started in this space is they hear that just 10 caps are everywhere and that it's a passive investment, and then tenants own their own home. There's no liability for you. And to me, you got started right in the thick of that. And it sounds like, if I understood correctly, you had 1,000 units and you were still trying to hit $10,000 a month. So even with 1,000 units, you weren't quite there yet. And the interesting insight that I just pulled from that is, for you, it wasn't really about the cash flow, because that's not necessarily how you build your wealth. So can you talk to us a little bit more about why, even if 10 caps still really existed, why that's not necessarily what you want to get to your goals?
Yeah, it's a good question. And I guess for clarity, we actually did hit the $10,000 a month goal long before the 1,000 units. We hit it and continued to be, then it was 15 and then 20 until this gentleman, his name's Brian, hit me over the head with the 2x4. But with regard to your question, it really, I don't want to prescribe a view necessarily and say this is the way you should view things, but really depends on what you want and what you're going for and what you value. So if I was talking to my 24-year-old self who only valued cash flow, I at that time valued something very different than I do today. But to kind of break it down in quantifiable terms, I'll try to use just simple numbers to illustrate it, and maybe we can unpack it a little bit more. But if, let's say you're watching this and you have a goal of creating, let's just say $10 million of net worth for yourself. And that's a completely subjective, arbitrary number. That could be 3 or 20 or whatever, a billion if you want to do that, whatever it is. The point is, let's just say $10 million is your goal. So let's just say you're buying a 5 cap asset. Okay, and there's a whole discussion we can have. Actually, let's have that discussion now, because this will make a little bit more sense. So if you have $1 of NOI every month, okay, that's what we do. We buy properties that produce income, and it's all about the net operating income and our goal of growing that NOI, because value is a multiple of NOI. So how much? So for every $1 of NOI, that's $12 a year, okay, at a 10 cap, $1 a month, $12 a year is worth $120 in equity or value, okay, unrealized gain. At a 5% cap, you have $1 a month, $12 a year divided by 0.05, that's $240. So $1 at a 5 cap is twice as valuable in terms of wealth creation than $1 at a 10 cap. So with that in mind, and we can go and say, let's say your goal is $10 million, and let's say you want to, let's say you're targeting 5 cap assets that you think will be sustained 5 cap, markets that, maybe Phoenix or, big properties, institutional quality, big markets. Okay, so at $10 million goal of net worth at 5 cap, you need 500,000 of NOI basically to get there. Okay, so let's just say you're going to buy, and that's, by the way, an annual number, 500,000, which is a massive number. I mean, everybody should be struggling to I'm not talking about it in small terms. It's a huge number. So that's an annual amount allotment. So take that into 12 increments. So that's about, let's just say $40,000 a month. Still a huge number to wrap your mind around. And let's just say your goal is to buy 1,000 units of whatever asset class you're focusing on. So take the 40,000 divided by 1,000. That's $40. So basically, you need $40 of increased NOI per unit, right, per month, to get a $10 million net worth. Which still, okay, maybe that's a lot. You can't, maybe you can do that, maybe you can't. So let's just say you give yourself 5 years to do it. So take the $40 a month per unit divided by 5 years, that's $8 per year. So if you buy 1,000 units and find a way to increase NOI $8 a year for 5 years, you have a $10 million net worth. Now, if you were operating at a 10 cap, you'd have to have twice as many units, or it would take twice as long, so on and so forth. So, it really just depends on what your goal is, as illustrated by kind of what we just went through. Are you cash flow minded? Are you value minded? Are you a little bit of both? It really and that'll dictate your strategy, I think.
I am so glad we went in this direction. Was not planned, by the way. I want to say why I love this, because with this podcast, I've now been on the phone with over 200 people trying to break into this space. And the common theme I hear amongst everyone, myself included, if I was to talk to myself starting out, is my goal was quite literally exactly like yours. I want to hit about $100,000 a year passively, so I can live a nice upper middle class lifestyle and not have to worry about bills and not have to worry about working. And like your friend Brian, I have a few mentors of my own who have helped me realize that's not going to fulfill you, number one. And number two, in the grand scheme of things, $100,000 a year, even if it's passive, it's not that much money. It really isn't, especially if, and I would love to jump into the tax piece of this too.
Sure.
You're getting whacked over the head with taxes. So how much of that are you really even keeping? Right. So if you would talk a little bit about what you realized at that stage to help those listening in, hopefully maybe not as like bluntly beating them over the head like Brian did to you, how you can kind of gently get them to maybe rethink their goals.
Well, I think it starts with kind of the reality. If you're working 20 years in a career, 10 years in a career, and you don't have enough yet, which is what's probably seeding the idea to go into something else. There's a deficit in path or your model, and you're not fulfilled in one way or another. The risk is that you take your mindset that puts you in that position and then apply it to a different asset class. It's lily pad to lily pad. You're not changing your view. You're just hoping a different view will save you. But the short answer is, it's really going back to what Brian really showed me, which is it's very hard to earn yourself wealthy. The tax regime is set up where it, 100,000 a year, 200,000, 500,000 a year, it just becomes more and more inefficient. You have a very strong and an increasing headwind that you're running against. On the flip side, up until this point, wealth has not been taxed. If I buy a property and add value to it and refinance that project and take capital out, I am not taxed on borrowing, right? So wealth is, the only way wealth is taxed is if you die or if you sell, right? So, and if you die, some would argue it really doesn't matter anyway, okay. But the point is, creating wealth and a focus on that is actually focusing on creating something that's most tax efficient. And then that itself can be leveraged to then generate income, to the degree that you would want it.
So I want to take a second to come back to where I kind of wanted to go with this, which is, and you opened my mind to this, I don't know, 6 months ago or whenever we spoke last at length. It was that chasing a 10 cap, let's say you can even get that today. Where's that going to be? It's going to be in the middle of nowhere. It's going to be with some heavy issues. And you said this, which blew my mind. You were like, even if you could get that, is it really actually riskier? Because think about this. If you're buying a 4 cap in Washington, D.C., it pretty much so does not matter what happens in the world. Washington, D.C. is always going to need affordable housing. If you're in the middle of nowhere and you're buying a 10 cap because you are desperate for yield, and then you run into a spot where maybe there's a prison or a power plant or one entity that drives the economics of that small town that pulls out, how are you going to trade? How are you going to refi? What if you have mass exodus? And then that risk is actually a whole lot more. And even if that doesn't happen, what are you going to trade out for? If you're buying at a 10, you think you're going to trade out for a 4? Probably not.
Yeah, no, you're exactly right. So, it really goes back to kind of risk reward. So if somebody's buying, let's say, a 10 cap today, this is a general statement. There may be exceptions to this, but generally speaking, you're in, a rural market that nobody has ever heard of, like Enid, Oklahoma, or something like that. So you're kind of in the middle of nowhere. Your financing options are terrible at best, but very limited. And if you do obtain traditional financing, it will be at a cost. It'll be costly and pretty high. So let's just say you might be in the 5 to 6% range, depending. Your spread, you may have 400 basis points plus or minus of spread. So yes, you may have a little bit more cash flow. But going back to what I said earlier, that project, when I got started, may have been in the 20s. So people today are saying 10 cap. Well, when we got, started in the fund model many years ago, we were trying to buy, to a degree, higher quality 10 cap assets. Well, today, the quality you get for 10 cap is very different than it used to be. So for us, we do not see that much risk of the Washington, D.C. market, Phoenix, markets that we're buying in, of having a lot of cap decompression. We think there will be a lot of demand. A lot of institutions are pouring capital. There's good, favorable dynamics in that space. So we think it'll be a sustained cap rate. And we're not typically buying, sub 3 or really sub 4 cap. We've bought some 4s, some 5s, some 6s, some 7s in the last couple of years. But even on that, like, to give you an example, we're putting debt on a property right now that we bought at roughly a 7 cap a couple of years ago, about a year and a half ago in Fund 7, and we're getting quotes in the 2s. So in that case, because we bought quality, now if let's just say it's a 7 even, and let's just say forget the 2.8 or whatever we might put on it. Let's say it's 3, right? We have 4 points of spread too, right? We have 4 points of spread. We have an institutional quality asset, all tenant-owned homes, occupancy in excess of 98%, tremendous demand, opportunity to grow revenue, and then the revenue growth that we do see is valued at, a 4 cap or a 5 cap or a 6 cap, depending on the market. So when you look at it over time, the risk reward, we should make more money at the lower cap than the higher cap, and probably took less risk in doing that.
So the fun thing about data is it's widely available. And I have two completely now useless degrees in statistics, so I'm way too qualified to go and spend way too much time looking at this. But I want to kind of piggyback off what you just said there, because if you go and look at what CBRE churns out, Northmark, JLL, they all have the data and they break it down by size, quality, yada, 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 from 2000 up until today. And what you just said is backed by data, which is that the air quotes 10 caps, they weren't legacy assets. These weren't 5-star resorts or even 4-star or even 3-star. It was 1 and 2-star communities that had absurd cap rates. And I know this for a fact, by the way, because I even have found old appraisals for properties that I own that traded for 10 caps in the mid early 2000s that now I'd be ecstatic if I can land for a 6 cap. And the truth of the matter is the bigger, nicer, more stable assets have always really been trading at pretty low cap rates. The thing that all this hype is born from are the worst performing stuff, smaller, lower quality, more tertiary markets. And what I'm kind of getting at with this, Ryan, is everybody is intoxicated with arbitrage, right? Like, oh my God, if I can just, like, you even see this at your local Goodwill. You have these folks who show up Sunday morning at 7 a.m. and they want to be there right when the truck shows up because they want to get someone's, antique whatever that's going to trade for $1 at Goodwill that no one else knows. And right, so people are intoxicated with this idea of quick, easy money arbitrage. But the thing is that and I know markets are really smart. Markets are really smart. It is very hard to, number one, find arbitrage, and number two, even if you could find it, you cannot replicate that. You can't build a business around arbitrage, or at least if you can, you can't sustain it for very long.
Yeah.
So that I want to piggyback into this question, which is, let's say hypothetically, 10 caps were everywhere, 20 caps were everywhere back when you got started. That doesn't mean that came without challenges. So you can help my audience excuse bust. What really limiting factors existed back then that kind of throws cold water on this idea that, oh man, I'm 10 years too late to this space?
Yeah, it's there's nothing new under the sun, and it's all relative. So you can argue if things continue on the trend, that it's currently on with cap compression on really all qualities. You can say 5 years from now, you can go back and say, 10 caps will be 8 caps. And man, I wish I had gotten back. It's a different version of the same thing, relatively speaking. But to your point on arbitrage, there's the initial arbitrage, that you're buying, so to speak. You're buying, what a lot of people are trying to do, I think this is saying it in another way, is buying $1 for 50 cents. They're bargain shopping. And in some cases for us, our model is, we want to create arbitrage by operational efficiencies. Kind of our plan on the project, our forced appreciation plan on the project. We want to grow and create arbitrage over time, but we want to buy. We don't think you'll ever regret owning quality, and so yes, in some cases your arbitrage is thinner at acquisition than maybe a 10 cap acquisition. And that's really the sales pitch. Don't invest with this group because their arbitrage is thin, ours is thick. But what isn't maybe fully understood is the cost in the long run to that model, I think. And so anyway, to your point, I guess to go back to your question, some of the challenges we faced initially is when we were starting with kind of the high cap, cash flow, heavy turnaround model, and I see this a lot because I talk to a lot of young guys who they have the greatest model and some of them have never bought a park before, and they're dead sure it's going to work. I talked to a guy recently who's talking about, he's never bought a park and he's going to buy 30 and roll it up and sell it to the REITs. I'm not saying it's not going to happen, but okay. But the point is it really depends on what you're going for. And sometimes, when you're getting started, you go for the high cash flow, all the things we've talked about, but scaling that model, that, heavy infill, taking apart from, park-owned homes to tenant-owned homes, that really is hard to scale and mass with a management apparatus. So, that's really part of the challenge is if you're starting with a model, what'll happen invariably is you'll do one and maybe it'll work. Let's just say it will work. Then you immediately go from one to planning on your next 100. And you may not realize that model may not scale very well.
I've always enjoyed talking to you, Ryan, because you're like 10 steps ahead of me. So we've bought 14 mobile home parks now. We've sold out of a couple, so a total of 1,400. So it's fun listening to you talk now, because I would like to think in 10, 15 years, I'm going to be sitting where you're sitting one day. And it's really fascinating listening to you say a lot of those things, because I myself have had that conviction that you speak of where, I'm going to do this, and I haven't bought a park yet, but this is definitely going to happen. And then you pivot. And I feel like Jim Collins talks about that in his books, your ability to strike the balance between having your hedgehog concept, yet not being too rigid to change with time. Yeah. And one thing that I've learned too is when you can't compete on a heavy stabilized stuff without a big fund like you have, you start to get intoxicated with more heavy value add stuff. And even the little properties, like 30 lot properties, can take a year or two to turn around. It's a lot of work. And like our mutual friend, Mike Conlon, said, you can only have so many projects before it just gets totally out of control.
Yeah.
So I'd love to ask you this question, and then afterwards, I'd like to pivot more into how you guys have successfully managed. But before we get there, for folks starting out in this climate today, which is totally different than obviously when you started out, sitting at the 30,000 foot view like you are, what advice do you have for someone getting started today?
Yeah, so first, get started. There's no better. I mean, there's really nothing better than real estate that I know of. 99% of my net worth is in mobile home parks and self-storage. So, I believe it. I like it. I would recommend it. But then really have a plan in mind. Don't think that activity will necessarily equal a result. Unplanned activity. So go in with a clear idea of what you're doing, why you're doing, and what you expect it to produce. And it may not produce. It may vary by 20%, but at least have a rough idea. And then if you're wrong, iterate and get better, but have a real clear idea of what you're doing. Don't just get in because it seems exciting and thrilling, and have real fundamental reasons for doing it. And then really, from there, understand as you build and grow over time, understand what you're building, and really, again, have a plan for your structure, your management apparatus, and really understand why you're doing what you're doing. I think is really, it's an eye-rolling answer, but it really is important.
Yeah, I am a huge fan of begin with the end in mind, Stephen Covey. And that's exactly what you're saying. You're quite literally, like you're doing at the beginning of this interview, breaking down the math and reverse engineering it. Any engineer would absolutely do that when building a bridge. Why is it any different if you're building your future?
Right.
It shouldn't be. Yep. So with that in mind, I am seeing a lot of people, and I mean a lot of people, as are you, raising funds, getting hyped up about syndicating. I mean, the sexy fun part of the business is acquisitions and raising money. And like our other mutual friend, Coleman Bubis, says, and he totally jacked this from someone else, everybody wants to talk about making the baby, and everyone starts disappearing when it's time to raise the child.
Great quote.
I love that. I don't know who actually came up with that, but one thing that I really, really, really want to talk to you about is what you've done extraordinarily well over the literally decades is you've built a management company organically rather than just outsourced it to some third-party manager. Because I'm seeing this everywhere where folks are like, oh, mobile home parks, I read an article in Forbes or I listened to this podcast. Now I'm hyped and I'm going to go raise $10 million and I'm going to build a portfolio and then sell it to a REIT. And then you ask them really basic questions like, okay, well, who's going to collect rent?
Yeah.
Well, there's going to be someone there who we're going to pay them $10 an occupied pad to have all these skills and make a whole lot of nothing and run this very efficiently. And I think what you've seen over the years is people try to do exactly that. They either outsource to a third-party management company or they hire without actually having understood the underlying asset and how to operate it. And the advantage that I think Ian and I have gained that you did extraordinarily well is you started off with heavy value add stuff. So you learned how to do this, to successfully operate in this business at its messiest. So now you can do it in scale very, very well. Before we get into how you do it, because that is just it's amazing how you guys operate. What would you say to the would-be syndicator or the, oh no, I just raised 10 million bucks and now I can't place it? What would you say to those two groups of people about your ability to, or at least how it breaks down when you don't build organically?
Yeah, going back to your engineering analogy, it's like building a house without a plan for the foundation. I think, yes, it's exciting, it's sexy to be a syndicator and a fundraiser, but we didn't start our first fund until I think 7 or 8 years after we started buying properties ourselves. And we only bought, and actually with pretty significant trepidation, only bought when we were really convinced the opportunity was there. We didn't have the capital. And so forming a fund was the way to capitalize on the opportunity. So it was born by, and I say trepidation because a fund you could buy, this is a very loose analogy, but you may have to buy 5 properties and hit 5 properties out of the park to make the same through a fund as doing 1 property and hitting out of the park by yourself. So it's actually a riskier proposition for the syndicator or the sponsor in that you have to do a lot more activity and do it well to wind up on the positive side. I can tell you with a lot of conversations I've had with syndicators, kind of green room conversations, I'll say, there's quite a few that have owned properties in the last 4, 5, 6 years, and some are fairly well known that actually did not make much, if any, money upon liquidation. So do not think syndication is a cure for any ill. If you don't have your foundation, I would highly recommend start with one, as painful and as slow and as unimpressive to your friends as that will be. Do that, and only when you think you have that down, start building a house on it. That would be. But with regard to the management, internal, external, I guess, question, to me, going back to the kind of the quantitative metrics that we just talked about, if the value of $1 a month, okay, again at 5 cap, is $240 of value. The value, that's the value for you managing it yourself, right? Every dollar you add, it's $240, right? The value to the property management company, assuming that $1 of NOI, let's just say you have a 33% expense ratio. So, or let's just say, I'll say it this way, let's just say 50% to make it easy. You had $2 of gross revenue for the $1 of net, let's just say, okay? So $2 of gross, and they collect, let's say 5% management fee. That's 10 cents of revenue to them. It's $240 of value to you. So who do you think will care more about that dollar? The person getting 10 cents or the person getting $240? Well, I think the $240, to me, I'll pay a lot more attention. I care a lot more than 10 cents. And it goes back to Jeff, one of my favorite examples ever of this is Jeff Bezos with Amazon and vending machines. It was like 10 years ago, he went into the warehouses of Amazon and removed the light bulbs from the vending machines because there was the cost to power them. There was the cost to replace them. Nobody needs a light to see what's in the vending machine. And I think he figured it would save about $1 million a year in cost for all the warehouses or something. It was some astronomical number from this little thing. So, assuming Amazon trades for, let's just say 20 times earnings, that's $20 million of value creation for its shareholders by removing light bulbs. And Bezos, who's this big picture guy, is focusing on light bulbs, and he's neurotic about the details. So anyway, that's more than your question, but
I had not heard that story, and I love it. And I hope Ian listens to this because I'm that neurotic about our stuff on our properties, and he calls me chintzy. So now I'm going to point to that example and be like, dude, I'm going to create an extra $1 million worth of value for us. I love hearing that. So this is a perfect segue into my next question, which is, what did you learn in your first 5 to 10 years of doing the more heavy value add stuff that really allows you to do what you do now even more successfully?
Well, we learned a number of things. So one, the structure we used initially wasn't the best structure. And I'll be specific just in case that's helpful. But the structure we started with for the, and I'll say from really 2010 to 2016, 2017 was kind of a militaristic structure where you have on-site managers. Every roughly 10 on-site managers are managed by a district manager. Every 5 district managers had a regional manager. It was very there's a hierarchy, and it was very bureaucratic. And as we grew, that structure did not scale well. It was not efficient. It became kind of bloated and bogged down and inefficient and costly. And so what we did is, we kind of pivoted in models, and again, kind of took the gentleman who beat me over the head by the 2x4, with the 2x4 on the cash flow. He's been in this business since 1970. And the newest member of his executive team joined, I think, his firm 36 years ago, the newest member. So in short, we kind of pivoted to his model, which has worked in far and away better so far, which is it's a very flat structure. So we have no DMs, no district managers, no regional managers. So we have, roughly 4, we call them vice presidents. They're not regionalized. So all properties are managed by all VPs. Okay, so it's not you have these, it's all are responsible for all. And so each property or each VP visits each property, boots on the ground, physically walks it with the manager. And there's a litany of things we do on site, but physically visits and meets with the manager. Each one visits the property roughly 3 times a year. So we have 4, and that's each. So the property is being visited by incredibly high quality folks who are responsible for that property, all 4 of them. And the benefit of it is each one of the 4 are very different. So you and I are different, as is Ian. So if the 3 of us were visiting a property, we all 3 would see different things. So which view is needed? And the answer is all of our views are needed. So we benefit from a variance of view and skill set across multiple touch points and on-site visits. And then as an additional layer to that, Jamie, myself, and Brian, we physically visit every property in the system at least 2 times a year ourselves. And, even in COVID, last week I was in 5 states. And so we continue to travel, and it's a very, I would say it's a fairly unsexy, very rudimentary, very flat boots on the ground strategy. And it's been incredibly efficient, cut a lot of cost, improved the quality of communication, oversight. Anyway, it's been really great.
I love hearing that because it's like the old trust but verify.
Correct.
And you're totally right. The things that I look for on a property are totally different than the things that Ian looks at when he goes to a property. It's totally different than our employees, what they look at. And again, back to Jim Collins, one of the best things you can do for your business is have good, strong, healthy debate, because then you're going to get to the right answer. You're going to hopefully put egos aside, and you're going to deliver real value to people. And that's what it's all about, because you call it arbitrage, call it whatever you want, call it being in the right place at the right time and being part of a bull market. The truth of the matter is you can't ride that wave if your property doesn't work. You cannot ride that wave if you're not actually delivering value. So to kind of beat up that slumlord mentality, it's still a lot of work. Even with 1,600 units across 30 states, you are still putting in a lot of work. And I think you've kind of answered my next question a little bit, but I want to give you the chance to maybe fill in some holes. What is it like to jump from 500 lots to 1,000 lots to 2,000 lots? What kind of are the pivotal moments, if you can even peg a certain lot count, where you have to start thinking and behaving differently, where a business model that you've reverse engineered breaks down at a certain threshold? And how do you think through that?
Yeah, I think it's, and for clarity, just so everybody, I guess my comments may make more sense. The total number of units our team has managed is 69,000. So 69,000 units. So,
I was way off. Apologies.
It doesn't matter to me then, because the number really doesn't matter in as much as it's evidence of the efficiency of the model, if that makes sense. So the point is it works at scale and has worked at scale. But the point in the whole, to answer your question, for us as we grew and built, we found that really, and I don't know that I would equate it necessarily to unit count, because it also matters on geographic location, if you're dispersed or if you're, in one addressable market. But, for us, we didn't start in one market. We started in this place and that place and, whatnot. So for us, it was around 5 properties when we started realizing, we could manage ourselves. We directly, Jamie and I, working directly with the on-site managers and maintenance team, we could manage ourselves initially 5 properties fairly well. Once we hit 6, that's when we started looking at bringing in other people to help, really to help build a more scalable management infrastructure. And that's when things really start getting fairly complex.
So then what I want to dive deep in a little bit before we end this interview is what advice you would have for would-be fundraisers, and how have you seen people fail? And while looking at other people failing, how have you taken those failures to make your machine work better?
Yeah, no, good question. Yeah, I have a lot of just things that I've seen and things that I would do different. I would say when somebody, and it's a really big deal when somebody invests with you. And to your earlier point, somebody investing money with you shouldn't, when you're starting, it's exciting because it affirms that somebody else sees what you see maybe, and they trust and believe. But ultimately, the exciting point is when you send money back. Your jumping up and down moment is sending the money back, not them sending the money to you. There should be a weight to that money. I mean, it's their lives, it's their experience, it's their trust in you, which shouldn't come lightly, right? So it's a really big deal. So I see some people a little too flippant, I think, about it and lighthearted about it, and then I've talked to people who they say, well, I'm going to start a fund. I've actually had several conversations with people who are starting their first fund, and they're like, well, we're going to start small. Our first fund will be 20 mil, and I don't like it when people say mil, but that's just my tick. But they'll say, we're starting small at 20 million or 30 million or whatever it is. Our first fund was 2 million. To me, a $20 million first fund is ginormous. My first fund was 2. Our second fund was 5. Our third fund was 10. So that first small fund of 20 million is bigger than my first 3 funds combined. And that was after 7 years of actually having experience in the business. So don't let ego drive the raise. Make pragmatic decisions. And then I guess a couple other finer points. When you're raising money, the focus should be on the team, not the model, the pro forma, the nice spreadsheet you put together. We actually do not issue pro formas at this point in our fundraising at all. I had a guy maybe a year ago say, well, you don't have a pro forma. This other group has a pro forma, and it was kind of an open-ended question. And my response to him is, why are we talking? Why did you call me? They've got a pro forma. So why are we talking? We don't do pro formas. The only question with a pro forma is how wrong will it be? Right? And so that's the only question, is how wrong will it be? It certainly, 100% certainly will not reach the penny accuracy. So the point is, do you really want people making investment decisions based on the only question is how wrong your model will be? But what I think a lot of people do when they start is they don't have the self-confidence of standing to scrutiny. So rather than saying, hey, here's who I am, this is what we're doing, yes, there are risks, here's what they are, yada, 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 they'll create this unbelievable pro forma and plan and make that the focus of the sales presentation in the hope that they don't look at them. It's look over here kind of thing. So I wouldn't do that. You can, anybody can do anything that they want. I don't know that that's the wisest way to raise capital, because if things don't go as planned, and it likely won't to varying degrees, that may be a problem.
I love hearing that, because I can hear people screeching and cringing inside. They love their pro formas, and don't get me wrong, so do I. There's something intoxicating about how wrong Excel is. Can't remember who said this, but I love it. There's been more fiction written in Microsoft Excel than Microsoft Word. And it's so true. I mean, I love being a data geek, going back and looking at our pro formas on our properties, and we've never been even in the ballpark on one of them. And that's just the nature of the beast. Like, it's an important consideration, man. And while we wrap up here, so you are on Fund 8, correct?
Yes. So we just launched, I think 2 days ago, our 8th fund. Yeah.
If I am an accredited investor looking to place capital with you, and my biggest concern right now is COVID, what would you say the risk, pros, cons, good, bad, ugly, about what you've experienced with COVID, and how you would reassure folks without a pro forma to invest in your next fund?
Yeah, exactly. I was about to say we don't have a pro forma. And also on that, just for clarity, have pro formas and a plan for the asset. The question is whether or not you're using that as marketing. They're two very different things. And so anyway, with regard to COVID, so far we've been, really fortunate. The mobile home park space has done, I would say, fairly well. Our properties, so our seventh fund closed in March, and I actually just ran some numbers on it. And taking the last 6 months, for example, on most of the properties gross income is up around 5% over the last 6 months alone, from July over 6 months prior. So there's been a nice increase, and so revenues are up on mobile home parks, which are nice. We've been able to sell a lot of homes over the summer, so we're actually filling a lot of vacant pads with home sales, which has been good. We see a lot of demand. Several of our properties are over 98% occupancy, and we can count the delinquencies on almost one hand for all the properties, and it's about 1,100 lots in that fund. So anyway, so far that's gone well. We also invest in self-storage, which we like a lot. Self-storage has been doing fairly well. It's handled COVID quite well, as people are now, they're moving up and down. They're being displaced. Storage benefits from friction, people moving. So a lot of people are moving, which is beneficial. You have people who now are homeschooling their kids out of their home, so they're getting more utility out of their home. So stuff has to go someplace. You also have garage gyms being built, and because you can't go to the gym, and a lot of tailwind factors that have been nice. So storage year over year, our storage facilities in Fund 7, that represents around 9,000 units, a little more than 9,000 units. Revenues up around 4% on the portfolio year over year. So positive numbers, which is good. So in short, we expect storage and mobile home parks to do very well, and we really don't see any long-term impacts to either business model.
So Ryan, to end, if anyone here listening wants to invest with you, how do they go about getting in touch with you? How do they go about investing in Fund 8? Yeah,
so if you're interested in allocating to mobile home parks and storage, or if you're a syndicator or looking at the space, feel free to reach out anytime, like yourself. We try to help, and I'm happy to be a sounding board if it could be helpful. But our website is elevationfund.com. It's elevationfund.com. And then my email is ryan@elevationcg.com. And then my direct line is 407-602-7662.
Ryan, I want to thank you again for taking the time to come here. I'm going to drop your information in the show notes on YouTube and the podcast, just so it's easy for folks to find. It's been an honor, man. Thanks for coming on.
I got some good one-liners from you. That was always good seeing you.
Entrepreneurs make mistakes, but with the overwhelming amount of free information out there, you don't have to be doomed to making those same mistakes. You just have to find a consolidated version of the most important information. What if I told you I'll gift you all of my DD mistakes I've made over the years for free? Just leave me a 5-star review, screenshot the review after it goes live, and email it to me at my website, archimedesgrp.com. Afterwards, join our Facebook group, Mobile Home Park Mastermind. You'll find hundreds of other mobile home park owners sharing ideas, contractors, and deals. It's free to join, and we would absolutely love having you join us.